Okay, sekali lagi. Assalamualaikum dan salam sejahtera. Welcome to next MPcast, the show where markets meets mind. I'm Gurunathan, and today we continue our journey into the world of trading, not with charts or numbers, but with stories, strategies, and real conversations. I'm joined by Gurunathan, educator, market analyst, life coach. We'll be chatting about trading versus investing in index equities. Which one is for you? So, Guru,
Yes,
what
so
are the major differences between trading and investing? How do you define trading and investment?
okay. So how I define trading and investment is trading is something you constantly buy and sell. Okay,
You are in
And
the market all the time.
you are in the market all the
Short term.
time. You're buying and selling. It's short term. You're using a smaller time frame, and you're in and out quickly. You're not holding positions.
Mhm.
Whereas investment, most of the time, is about just buying
Mhm.
and holding the positions,
Mhm.
right? And investment is usually for long term, and you use either a daily, weekly, monthly chart. Even I personally use the 4 hourly to enter the trade, and to sustain the trade, I look at the weekly time frame. So investment is more for long term. Trading is for shorter, quick term, and I would say trading is for cash flow lah. You know, you want to pay the bills, you want to get some cash flow, go for trading.
Mhm.
You want to grow your wealth, you want to compound it, then you go for investing.
Mhm.
Yes, so that's how I differentiate.
So, if say I hold a positions in the market for 3 months, is that trading or is that investment?
For me, that's considered investment already. Once you are in that investment
What is your timeline? Holding a position, is it 2 weeks? Is it 3 months? Is it 1 month? What is your
Actually, to
timeline?
be very honest, Azul, that is decided by the market.
Of
Because when I invest, I also have a target where I want to take the profit and then compound it and then enter a new position. So where I set the target, when the target will be reached, I don't decide. The market decides.
The price target.
Price target.
Yep.
Yes, price target.
Is
And the market
time
decides it.
target.
And usually anything between a couple of days to sometimes even up to a month or 2 months or even more, if I'm really going long term, that is already investment. So if you're holding something for 3 months, that's already investing already. If you are doing something on a daily, hourly basis, like minute in, out, that is scalping, trading. So that goes under trading category. Yeah.
Okay. Trading equity indexes and investing in equity indexes. How does it do? Should I go into both? Should I go into trading? Should I go into investing in index equities? What should I do?
The real question is, how much time do you have on a daily basis to do this? If you have a lot of time and you are not doing anything else, you can do trading. But if you're working full time and you just want to compound your wealth and test out whether this is working for you, that's go for investing. And I usually tell my students, if you don't have time at all, just do the weekly chart, because you only have to look at the chart on the weekend when everything. I'm doing index funds, right? So on the weekend everything just shuts down, quiet, so you get a nice overview of the market. On the weekend, analyze the market. If there is a signal, there's a setup, put in your positions, and forget about it for the rest of the week. And then next weekend you look at the chart again. So depends. So if you have a lot of time and you are able to look at the market during market active times, then go for trading. You don't have the time, you only have time on the weekend.
Depends on the person.
Yeah, it depends on the person. Then go for investing. If you have a lot of time, you can do both, all the better, because one for cash flow, one for
Because
long
if
term
you tell
investment.
somebody who got all the time in the world to just invest, but yet the person is sitting in front of charts, it doesn't work.
Doesn't work also, because when you invest,
we'll put something in.
that's right. When you invest for the long term, what it really matters is you have enough free time to do other things.
Of course.
So you're either, if you're not working, you are giving your time to the community, or you're doing some hobby, you're traveling, you're doing something else. while the market is taking care of your investments. Don't invest and then constantly look at the chart like what's happening.
You will do something.
Correct.
Okay, maybe perhaps we backtrack a bit.
Yeah.
What are equity indexes?
Okay. So index funds are basically, imagine this. Okay, let's talk about the US 30, one of my favorite index funds, right? Imagine the top 30 companies in the US. Instead of buying individual stocks of the 30 companies, they are all lumped together in one basket. So instead of buying 30 different stocks, you're just buying a combination and an average price of one.
Spreading your risk. Yeah.
You're spreading your risk because, say, if company A comes down, if company B goes up, the whole index kind of averages everything out. And a fund like the Wall Street, it's 100 over years old, bro. It's 100 over years old. And if you take a long view, a macro view of the chart, it's only going in one direction, up. So very, very good for investment. Same thing with S&P 500 as well. 500 top companies in the US. And I always tell my students, these are stocks and companies which are too big to fail. They'll never fail.
The government sure will bail them out.
They will be backed up. And they're just too strong. They're cash rich, they're asset rich, and their market cap is huge. So they are too big to fail. And when you trade or when you invest in these funds, you know that, okay, things are a bit more stable. They are not crazy volatile.
These are the blue chips. Yeah.
Yes, they are blue chips. They are volatile. They can get volatile a bit, but they are not as crazy volatile as other instruments. So that is basically index funds. And all countries have an index fund. I personally like 3 in the US, the NASDAQ, the US 30 and S&P 500. Very stable, very predictable and all those things. And I like 2 in Asia, which is the Nikkei and the Hang Seng Index. Almost every country has one. We also have one. In Malaysia, we have one. So pick and choose which index is suitable for you, for your portfolio, for your capital, for your risk profile and all those things. And do look into index funds. And a lot of people think index funds is not exciting for trading. I beg to differ.
Yes.
I beg to differ. I scalp on index funds and they can be quite as exciting. Yeah, they can be very exciting.
More exciting than gold?
Let's not go there. Let's not go there.
Of course.
Gold gives me a high. So index funds, they are volatile yet kind of predictable. So you can forecast the movement, unlike gold. Yes, you can forecast gold, but sometimes they just gets a bit too crazy. Index funds, they are stable, they are volatile, and predictable, and you are able to forecast the markets.
Depending on your portfolio, if you invest gradual move up, but if you are trading, you are looking for both ways, up and down. You can make money.
Correct. Up and down, you can.
So depending on your portfolio, right?
That's right. So like I said earlier, and I also in the previous episode we spoke about this. What is your goal in trading? Or what is your goal in this whole financial market? Do you just want to park your money, invest, and maybe just check your portfolio once in a while and adjust it accordingly? Or do you want to be actively trading? So it depends on what you want to do. Then you choose trading.
How do I know what is right for me? How many hours in a day, how many minutes in a day that I know I can trade if I have that spare time?
Okay. Trading is most effective when you trade during the market active hours. So are you able to spend time and sit in front of your terminal during the market active hours? So Asian hours. Are you able to sit that, say, 4 hours, say from 8 or 9 to 12? If you're able to sit and focus, trading is for you. No, I can't. I have to pick up my child. I have to send my child to school. I have to do this. I have to do that. Then don't bother. Just go into investment. Or go into bigger time frames, go into 4 hours, go into 1 hour. 1 hour also, I don't recommend. 4 hours, because you only check the market every 4 hours.
The price action, the levels easier to look.
Correct. So, depends on how much time you have in hand and how well you can control your emotions. Because trading messes up your emotions a lot. So if you can manage your emotions well, and if you can stick to your plan and be disciplined with that, you can do trading.
What is a good time frame to trade? What is advisable time frame to invest? You've been mentioning H4 for investment, but how about trading?
It really depends on Zul. I have tried 3 minutes, I have tried 15 minutes, and I have tried 1 hour. Okay, 15 minutes is kind of my sweet spot. 3 minutes, too crazy. 1 hour, too slow. 50 minutes, just nice sweet spot. I don't understand how people do it on the 1 minute. I salute them.
Of course, me too.
I don't know how they do it.
Yeah.
But 3 minutes is just too much for me. Again, I think it also depends on your personality.
Some people need that excitement.
And some people just
for that, and they do better in that.
Correct. Some people want to be in and out very quick. In and out. I just want to spend 1 hour, whatever I make in 1 hour, okay, done. So they'll go for 3 minutes or 1 minute. But I'm okay with just 15 minutes, and I just spend first half of the day, like say 8 o'clock. I start 8 o'clock, finish at 12 p.m. 12 p.m. About just before lunchtime. So for me, 15 minutes is just fine. And if you are going for investing, 4 hours daily is perfect. Weekly is even perfect. If you have a big capital, because your stop loss tend to be very high.
How much does one need to put in to be in equity indexes?
If you are working with or if you are trading on a platform which gives you margin, then anything between $5,000 should be good enough for you to start. You can actually start with a lot more lesser, but then based on your risk profile and all that, your lot size become very small. When your lot size become very small, like for example, if your lot size is correct, if your lot size is 0.2, and based on your say technique, you're gonna get 30 pips, 50 pips, not enough lah. Right? So if your capital is higher, your lot size can be slightly higher. So say your lot size is 5, or different platforms calculate lot sizes differently. I'm just saying, for example, 5 per dollar. And if you get about 30, 50 pips, that's quite a handsome sum of money for a day, $250 a day. That's quite good. So it really depends on your objective, your risk profile, and what is your goal. What is your investment goal? What is your trading goal? How much are you trying to make? If you're trying to make, say, 20,000 a month, but you want to start off with $1,000, there is a mismatch. It doesn't work that way. So you need to think about your objectives and then backtrack and then have that capital and time and the plan to do it.
How do I know I make it in the market in terms of investment? How do I know I am beating the market?
Nobody can beat the market.
But I mean, in terms of performance, how do I know instead of just putting it in mutual funds, I try and let other invest for me and manage my money. Now I can invest on my own. How do I know I'm making it in the market?
So first thing first, let me just put this out there very clearly. You can never beat the market. The market is a big giant force. Don't try to beat the market. Participate in the market. The market is moving. There's a trend. Participate in it. Take part in it. Because when we are trying to beat the market, we will do some really crazy things,
of course,
which will just burn a lot of accounts, right? So don't try to do that. Now, how do I know I'm getting better results than other investment opportunities, right? If mutual funds is giving you 6% or 5%, 7%, but your investment is giving you, say, 20% per year, then your investment is, of course, better than that. But, of course, you have to actively manage it. When it comes to mutual funds or any other funds, there are people managing, professionals managing that. Or if you want to give somebody your money to invest or trade, first of all, be very careful because it's your hard-earned money. Be very careful. Know who you're giving.
That is what surprised me, and I think you also know. Sometimes our face appear on Telegram's channels and people, and it's so easy so some people out there to give money to all this. Hi, my name is Guru. Put 1,000, and then it's very surprising to me. So easy for people to part ways with their money.
Unfortunately, we all are humans. And as humans, we have greed.
Yeah.
And greed will drive people to do things like that. It's because of the sweet talk and the big promises people give. But just be very, very careful, because you will never be able to grow your money as much as you want unless you put in the time and effort. Nobody else is going to do for you. Okay, mutual funds and any other financial instrument, they are going to give you return, but it's only going to be certain amount. If you think that 7% not enough for me, 6% per year is not enough for me, you do the work, you learn the technique, you go into the market, you manage your funds.
You burn the
Because
candles. Yeah.
nobody else is going to work as hard as you in the market for you. Right? So yeah, be very careful when you part ways with your money to people who you don't know.
Okay. So in the previous episode, we talked about trading psychology, looking at index equity. How does one avoid? One thing about index is sometimes you look at everything. For example, you mentioned about US 30, Dow Jones. So it's either you compare it to Dow Jones transportation, or you look at each 30 individual stock, Goldman Sachs, for example. How do I avoid that trading that analysis paralysis? Looking
Yes,
at everything. Yeah, one thing about me is last time I used to do that when I trade in Dow Jones.
Yeah.
I look at all the 30 small, I mean the all the stocks in Dow Jones.
Yeah.
How do I avoid doing that?
Okay. Paralysis is something which all traders will go through. And they will come to a
Put in
point.
fundamental analysis somewhere.
Yeah. They'll come to a point where they realize, oh, okay, this is too much. I have to go back to what I started off with. It happened to me. I started off with a very, very simple way to find entry and exit position. I thought, hey, why so simple? I need something more complex. And I went all the way. My chart was looking like some burung sarang.
Everything,
So many things there. And it didn't work. And I realized I deleted everything, in your chart, delete all indicators, delete everything. And I put back my first just simple indicator that worked perfectly. So how do you stop analysis paralysis is use one technique, backtest until you want to vomit.
Until
backtesting. Backtest. So when you backtest as much as you can, your confidence and trust in that one indicator, in that one technique, in that one setup will grow. So when you have that confidence, you will slowly stop over analyzing. You just want to have that one entry point, one exit point using that one particular indicator. When I say indicator, what I don't mean a particular indicator. It can be a setup, it can be SNR, it can be there's so many.
The technique.
Because I always tell this to my students: when you look at a chart, there is literally 1,000 ways to trade it. 1,000 ways to analyze it, interpret it, and trade it. All you need is just one. You need one which is consistently profitable. When I say consistently profitable, is 7 out of 10 times you win. That is very consistent already. 6 still very profitable. So if that setup indicator is doing that for you, just stick to it. And that's how you get over analysis paralysis.
Yeah.
But they will have to go through. They will have to go through that.
The thing is it you trading or is it your technique trading?
Technique.
How much do you? Trading is a skill. So it's either you know, you don't know, you don't know. You know that you know. You know that you know, and it's become automatic. That's the skill levels. How do you actually know you're supposed to follow your technique 100%, or when skills, or sometimes you as traders, because we sit in front of chart, sometimes we know this one goes up, it won't reach my TPs, or it will go straight to my stop loss. We have that calling. We know. We know.
It's the gut feeling.
Yeah. So how much is your trading should be just following 100% the system, or how many percentage you put it into you, not just everything about technique?
I think technique more and my emotions lesser. So I do sometimes believe in gut feelings, though I think I shouldn't, because you are supposed
Kalau
to.
aku keluar tadi,
That's right.
ataupun kalau aku buy.
That's right. That's right. So what I've started doing is whenever I have that feelings, I move my SL to BE because it becomes a free trade. If it's jadi, jadi. If it's jadi, at least I don't make a loss. So if I have that emotion, but I think we will have to come to a point where you believe in your technique and your setup.
And your plan. Yeah.
Because in the end of the day, your emotions can vary.
Of
Your
course.
setup will not vary.
Yeah.
Your indicator will not
Yeah,
vary.
even we have the best athlete, they have bad days.
Correct.
Yeah.
Correct. Look at, my favorite Formula One driver, one of my favorite Formula One drivers is Lewis Hamilton. Look at what he's going through now. There's so much of emotional roller coaster.
Up and down.
But
Ferrari.
he's one of the best of the best. 7 times world champion and all that, right? And any other athlete, for example, they go through that emotional roller coaster and it affects their performance. But indicator doesn't have emotion. Data doesn't have emotion. Your setup doesn't have emotion. SNR doesn't have emotion.
Sometimes that's
Correct.
Yeah.
So I think we all have to rely on the charts, on the market. My coach last time used to tell me one thing. How do you know where to enter or exit from the market? Who's the best person to tell you where to enter and exit? Who do you think?
Your technique.
It's the market.
It's the market.
It's the market itself. So you look at the market and ask the market, where should I enter? Market, where should I exit? The best person to tell you where to enter and exit is the market, nobody else.
That's the problem if sitting in front of the chatulong.
Yes.
Dipanggil.
Yes.
Especially alone at night.
Correct.
And you don't have entries yet.
Correct.
Dipanggil.
Correct.
And your buy limit or the place that you're supposed to enter the market is down there.
Yeah.
It almost reached, then it goes up.
Yeah.
And one maru bozu.
Yes.
That's the thing.
Yes. You know what? That happened to me today. It happened to me today. I'm just waiting.
Almost reached.
I have to go for recording. Waiting. Then I realized, no, this is not what I should be doing. Shut down. Close my my orders, shut down my terminal. I came over here. So sometimes it's not healthy also lah. Sometimes it's not healthy for you to be just looking and staring at the progress. That's why I have a cutoff point. By 12 p.m. And my US session, I just spend about half an hour, 1 hour maximum. After that, I must go to sleep because next day I'm waking up at 6:30. And whenever I sleep late and I wake up late, my next day trading getting affected. So I have to keep to sticking to the trading plan and being disciplined. Yeah. It's a process.
What is a typical day for those who are trading and also investing or ONN in equity indexes? What is a typical day for you and maybe your students? What is
so typically depending on the markets which we trade according to the active market hours. So if I'm trading the Asian markets, I'm actively trading during the Asian hours. So between Japan opens at 8 o'clock and Japan actually opens at 8 o'clock and trades 23 hours. Hong Kong opens at 9 o'clock our time and closes at 12 for 1 hour break. And then after that, it kind of slows down. So I am trading anywhere between 8 to 12. That is my active trading hours.
That's
and
for Asian,
correct. And between that, because I also trade the 4 hours and the daily. So daily, I do it in the morning before the market opens. 4 hours, every 4 hours, I have an alarm in my phone. Tells me to check the market, whether got signal or not. If there's a signal, I calculate my lot size, I put my orders, and then I forget about it. So that's my investment part. My trading part is more active between 8 a.m. to about 12 p.m.
So that's your typical day. So there's things to do. How about things to avoid? Not that many people talk about things. For example, staring at chart as 12 to 2 p.m.
Yeah.
Nothing is happening.
Nothing is happening.
But yet you are trying to, maybe you're looking at Nifty,
Yes.
India,
Yes.
and then maybe you're looking at CAC, France.
Yeah.
You're looking at suddenly you never know about Milan. Suddenly you go into
Correct.
Europe market.
Swiss is there, Germany is
Swiss,
there,
everything
DAX
is
is
there.
there. Yeah,
Yeah.
everything is there. Pick and choose. Pick and choose what you want to do and how long you want to stare your screen. Because, okay, think about this. Think about this. If you are staring at the screen for 12 hours, you should be a super duper millionaire by now.
Of trillionaire.
Trillionaire.
Yeah.
If you're not,
Mm.
then there's no point doing that. Okay. So if you're not a super duper millionaire
Mm.
by staring at the charts for 12 hours
But
a day,
that
don't do
FOMO.
it. FOMO, yeah.
Yeah. Fear of missing out.
Fear of missing out is something you will get over
Mm.
by
Or
time.
if you don't enter, it goes up.
It's okay. The next signal will come.
When?
The next signal is coming very soon. It's coming very. Market will constantly move, Zul.
Yeah, of course.
Market is not going to give you one signal and not give you signal for the next 2 months. No, market will constantly move. That is the
is
market's
always
job.
there. It's whether you still have the money to be in the market.
So protect your capital.
Yeah.
Protect your capital. So don't take trades which you are not supposed to take and burn your account because your capital is your arsenal, Yeah, not the football club. It's the
Liverpool. Just lost. Yes, we just lost.
yeah. So your capital is basically your army. If you're going perang, you're going war, don't lose your army. If you lost your army,
You're not there anymore.
you can't go to perang.
yeah.
So protect your capital first. Make sure you only take trades which is going to build upon your capital. Not
That's why
otherwise.
equity indexes. That's why one of the best for you, the instrument to go into for your long-term investment
That's right.
is equity indexes.
Yes.
Yeah.
And also even for trading, the pattern is a bit more easier to
Predictable.
forecast.
Easier.
Yeah, easier to
Yeah,
forecast. So
I went through your social medias and you talk about 3 classes. One is equity indexes. One is oil. I don't know whether it's WTI or Brent. And another one is gold. That one is because of volatility, for intraday perhaps. Looking at all these 3, what are more suitable for trading and what is or are the instrument that is more suitable for investing?
I might be a bit biased when I say this. For young people, gold trading works well because they have that emotional capability to just keep going, and keep going in and out on a smaller time frame.
And the friends that they have.
Correct.
Everybody talk about gold.
Yes. As you grow older,
Yeah.
I realized index funds are a bit more suitable for me because they are not very too hard on your heart. So actually, gold works really well for short time frame trading. But it can be very, very volatile on unpredictable times. Oil also is very easy to be manipulated by market forces. So I try to avoid these 2 things personally. I do teach the techniques which I teach can be used in any market, but personally I like index funds because they are a bit more stable, a bit more easy going on my
But actually,
emotions.
all 3s, you can see if you look at higher time frames, easier to see the trends.
You are right. You are right.
Easier to read if you are doing technical analysis. Easier to read.
You're right. You're right. They're easier to read on a higher time frame. But traders don't like higher time frame.
M5.
Yes, they like M5, M3, M2, M1.
How?
Yeah. So and you tend to see a lot of noise. Like if you open a gold chart or even your WTI oil chart, you go to 1 minute. You don't know what are you looking at. It's like looking at Maggie Me. It's like so much of noise going on, and that sometimes is very stressful to look at. Again, when you are trading, your emotion plays a big role, and you don't want to be emotionally traumatized or troubled when you're trading, especially gold and oil.
More relaxed index equities.
That's right. For me, at least. Different people have different opinions.
For the older.
Yes.
You never walk alone. Okay. And Guru, we move on to the next segment of the XM Podcast, the rapid fire questions. Are you ready, Guru?
Ready?
Okay. What's the biggest mistake you made in trading and what did you learn from it?
Biggest mistake is not using stop loss.
Yes.
The biggest lesson I learned from that is use stop loss.
Of course.
and never cut stop loss. So again and again and again
Yeah,
and again. I because a lot of my students also have done the similar mistake, and I learned from them.
All of us, yeah.
I learned from them also. The best traders lose big because they don't use stop loss or they move their stop loss. Stop loss is there for a reason.
Once you move, your losses become bigger. It's harder for you to
cut the loss. Yes. Stop loss is there for a reason. Is to stop your loss.
To limit your loss.
Yeah. So use it.
And the second question: do you have a trading superstition or ritual you swear by?
Yes, my trading superstition or ritual I swear by is I must meditate for at least a couple of minutes or maximum 20 minutes, 30 minutes every day. I must journal, both journaling my trade and journaling my thoughts. And I also must exercise, at least go for a walk. 10 minutes, 20 minutes walk. It clears your mind. It kind of gives you a different perspective of certain trades, certain markets you're looking at. Even when you are trying to think about how do I manage my that portfolio, this portfolio. When you go for a walk, everything just comes to you. So yeah, I try to do these three things on a daily basis.
I got two of them: the meditation and the journaling. But the hard part is exercise. Exercise because now at my sessions at night and daytime is either too hot or it rains.
Correct.
So how do you keep doing that? I mean, especially brisk walk. What do you do?
Yeah, I mean, I just try to get half an hour of
Gym
walk.
is out of the question for me.
Yeah. So I found two things to do. So where I live, we have a nice compound to walk. So I just try to go out 20 minutes, just do a quick walk while listening to a podcast and something like that. Or if I really can't go out, where I trade in my room, I do some light exercises. I do some squats, some push-ups. That's enough to increase your heart rate.
I tried planking. Oh my God. Nah.
not for us.
Not for us. Yeah.
I mean, just move your body because we traders tend to just sit for too long of a time.
Yeah, 2 hours straight. Only traders can do that. People don't understand that traders can sit in front of charts 2 hours
or sometimes longer
and doing nothing. Just
Just waiting for setup, right? My wife will ask me, "What are you doing? What are you looking at?" I'm working, but you're doing nothing. No, that is part of the work.
People don't understand. Perhaps she's watching this.
Maybe. But as traders, we have to move. We have to physically be active and move.
All right. So recapping back to what we touched so far, equity indexes, that's better for our heart.
Yes.
And longer terms.
Yes.
For investment, basically you are spreading your risk. Easier to read. Safer market.
Yes.
Anything happen, US government, Trump will help.
Correct.
Believe in Trump?
Can I not answer that?
Very hard. So, but basically, it's a safer instrument for longer portfolios if you're holding your position and basically easier to analyze. And you're talking about putting monies in the 30 of the blue chips in Wall Street.
Correct.
So safer for your equities.
That's right. And even same thing with Japan and Hong Kong. They are all the big Japanese companies put into one basket. So imagine how strong they are.
Interesting you mentioned about Japan. I put in a bit, adding a bit. If we look at 1980s and 1990s, we had big companies from Japan. We had Sony, PlayStation. We had Toyotas. We had, and now only Toyotas as one of the company that is challenging. I mean, is there up to the European and US market, US companies. What happened?
Well, you see, what happens with these index funds is when you have the top 30 companies, if the 31st company does better than the 30 companies, it will get replaced. So that is what has happened because there are a lot of other companies which are doing much better.
For Japan, what happened to Japan?
I think if you're talking about big Japanese companies which has gone bust or which has gone to obsolete, is because I think they failed to innovate. They fail to innovate. You just mentioned the names. Sony. Look at the camera division. Okay, they are okay.
The
The
phone.
They used to have
What
some
happened?
nice phones. They didn't innovate. Nissan,
Nissan, yeah.
really good company, really good cars last time. What happened to them?
Yeah.
Didn't
Only
innovate.
Toyota now.
Yeah. So there are a
Very
lot of
sad.
companies. They fail to innovate.
So should I go to Nikkei?
Think about it, look at it, analyze it, and then tell me what you think.
Technical.
Yes,
Yeah,
technically.
If technique say buy, you buy.
Correct.
Technique say sell, you
Correct.
sell.
Correct. And the Nikkei's price is
It's-
fighting now
yeah.
with the Dow Jones. So they are really up there.
And some catching up to do for Asian market and European market actually.
You're right. You're right.
Since 2008, we had US market pop up already. DEX catching up. Nikkei,
Yes.
catching up.
Nikkei has caught up.
So the valuation is still there.
Yes, Nikkei has caught the European markets are still struggling, I feel. Especially, don't talk about the FTSE.
Yeah.
FTSE is struggling. So many other markets are struggling, except for DAX in the European region, which is doing quite well. The rest of them are still struggling, trying to find a trend, trying to find a footing. We'll see.
You can see if traders talk.
We will not stop.
And basically, Guru, that wraps up today's episode. Huge thanks to Gurunathan for joining SMP podcast and sharing his insights on index equities, is especially if you are investing in index equities. If you enjoyed this chat, don't forget to subscribe, leave a review, and follow XM on YouTube and Spotify channel. Thanks for listening, and catch you next on XM Podcast.